right, everyone, get ready, because today we are going deep into the world of high finance, but with a bit of a twist.
Oh.
Yeah, we're talking algorithms, machine learning, and asking that big question. Can machines actually outsmart the market? You sent over some really cutting-edge research on this.
I did.
3 academic papers
Yeah.
that I think are going to blow some minds.
Well, let's just say these papers are tackling some of the biggest questions in investing.
Okay, I am ready. Let's unpack this.
Okay.
Our first paper jumps right in deep end, I guess you could say.
Okay.
It's titled, Can Machines Build Better Stock Portfolios? I'm already picturing like a robot wearing a suit picking stocks. It's kind of funny and scary all at the same time.
That's a pretty vivid image, haha, but it's not too far off from the reality of quantitative investing.
Really?
Yeah, this paper is diving into whether machine learning models can actually build portfolios that do better than those managed by humans. And their findings suggest that, yes, they can, at least when it comes to this key metric called the Sharpe ratio.
Okay, now hold on a second. For those of us who don't speak fluent Wall Street,
Mm-hmm.
break down this Sharpe ratio thing for us.
Sure. So it's basically like a scorecard for how much return you get for the risk you take.
Yep.
Higher is better, and anything above 0.4 is pretty impressive.
Gotcha.
What's really fascinating here is that these machine learning models can get those impressive Sharpe ratios by analyzing massive amounts of data
Right.
and finding these subtle patterns that we humans might miss.
So they're like those chess-playing computers that can see moves that humans wouldn't even dream of.
Yeah.
Okay, but there's always a catch, right?
Yeah.
It can't be that simple.
You're right. There is a nuance here.
Okay.
The researchers found that including certain defensive characteristics in the portfolio can actually backfire,
Okay.
like focusing on low beta stocks.
Low beta, what was that again?
So beta's basically a measure of a stock's volatility compared to the overall market.
Okay.
Low beta stocks tend to be less risky, meaning they don't swing up and down as wildly.
So less risk, less stress. Makes sense to me.
Right. You would think that wanting less risk would be a good thing.
Yeah.
But here's where it gets interesting.
Oh.
A portfolio that's overly focused on defense might actually have a negative market beta.
What does that mean?
It's like pulling on the brakes while everyone else is hitting the gas.
Oh, okay.
The market moves up and your portfolio lags behind because it's designed to kind of zig when the market zags.
So even a robot needs to know when to take a risk.
Exactly. Exactly.
Interesting. Never thought of it that way.
It's all about finding that sweet spot between risk and a reward, and these AI-powered models are they're starting to get really good at it.
Okay, this is mind-blowing stuff. But before we go full AI evangelist here,
Okay.
let's talk about paper number 2.
Okay.
This one is from AQR Capital Management,
Yeah.
which I know is a major player in the quantitative investing world.
They are.
These guys are known for their, well, let's just say their attempts to time the market.
Yes. AQR is a leader in using algorithms to try and predict market movements
Right.
and make strategic investment decisions.
Speaking of predictions,
Yeah.
that brings us to our third paper, The Virtue of Complexity in Return Prediction.
Right.
This title alone has me intrigued.
Yeah.
What's the deal with complexity? Is this saying more complicated is better?
That's a great question, and the paper really dives deep into this idea.
Okay.
So think of predicting market returns like you're trying to map this vast and incredibly detailed landscape.
Okay.
Simple models are like really crude sketches.
Okay.
They're capturing the basic outline, but they miss all the nuances.
I can visualize that. So more complex models equal a more accurate map.
In theory, yes.
Okay.
But here's the catch.
Okay.
If you only have limited data, too much complexity can make your map unreliable. It's like you're drawing in every tiny detail based on just a few glimpses of the landscape.
Right.
You end up with a map that's more fiction than fact.
So how do we find that sweet spot? How do we avoid getting lost in the the weeds of complexity?
That's where shrinkage comes in.
Shrinkage.
Yeah, imagine trying to perfectly trace like a winding coastline.
Uh-huh.
A simple line isn't going to capture the inlets and the curves, but drawing every little detail based on like a small map would be messy.
Right.
Shrinkage is like smoothing out those lines.
Okay.
You're getting the shape right without all that unnecessary jaggedness, and that's what makes the predictions stable.
Shrinkage. Okay, I'm going to have to add that to my investing vocabulary.
Uh-huh.
Now, this paper also mentions something called Ridgeless regression.
Yeah.
Honestly, it sounds like a magic trick to me.
It kind of is, haha.
Okay.
Ridgeless regression lets you use really complex models even when you don't have a ton of data.
Wait, so even with limited data, that's bending my brain a little.
It is a bit mind-bending, but the key takeaway is that complexity, when paired with shrinkage, can become like your secret weapon for better predictions.
Okay.
Especially in the real world where, models are always a simplified view of reality.
All right, I'm trusting you on this one.
Uh-huh.
So did the researchers actually put these ideas to the test? Did they try and predict the market using these, complex models?
Oh, absolutely.
Okay.
They tested their models on predicting returns in the U.S. stock market.
Uh-huh.
And guess what?
What?
Complex models, like the ones using something called random Fourier features, consistently did better than simpler ones.
Okay, you have to explain this one. Random Fourier features.
Yeah.
That sounds like something out of, like a sci-fi movie.
Haha. So imagine you have this, basic black and white photo.
Right.
Random Fourier features are like adding colors, textures, details, creating this richer picture for the AI to learn from.
Oh.
It's transforming that original data into a more insightful set of inputs for the model.
So it's like giving the AI supervision.
Yeah, you could say that.
That's pretty cool.
Yeah.
But did these complex models actually work? Are we talking about results here?
The results were actually quite promising.
Okay.
They achieved an average annualized Sharpe ratio of over 0.4, which is considered quite good.
Hold on, I thought we were done with that Sharpe ratio thing.
We are, haha.
Oh.
But it's important to remember what it represents.
Okay.
It's all about achieving a good return for the level of risk you're taking.
Right.
And a Sharpe ratio above 0.4 suggests that these AI-powered models are doing just that.
Okay, so maybe the robots are onto something here.
Haha.
But before we get too carried away,
Yeah.
I have to ask, did they compare their results to any existing benchmarks?
They did.
Oh,
and this is where it gets really interesting.
Okay.
They compared their findings to this very famous study by Goyle and Welch, which essentially argued that market prediction is impossible.
Oh, yeah.
It's like the go-to argument for, those who say you can't beat the market.
That you can't time the market crowd.
Exactly.
So did our AI overlords prove them wrong?
Well, let's just say they presented some compelling evidence.
Okay.
By using those complex models and shrinkage techniques.
Okay.
They were able to achieve positive out-of-sample returns, meaning they could actually predict future market movements.
Wow.
That weren't part of their initial training data.
Okay.
They even applied their methods to the same data set used by Goyle and Welch and found significant improvements.
Wow.
It was like a head-to-head challenge that really showcased the potential of these these advanced techniques.
So rewriting the rules of the game.
Yeah.
That's pretty impressive. But but before we crown AI the king of Wall Street,
right?
Let's take a step back. What were some of the key takeaways from this empirical analysis? What should we, as mere mortals, be paying attention to?
Well, first, complexity matters. The
Wow.
more features you can incorporate into your model, the better it can capture the nuances of the market.
Okay.
Second, shrinkage is crucial.
Got it.
It helps to stabilize the predictions from those complex models,
Okay.
making them more reliable.
So more information, but make sure it's good information.
Exactly. It's about using the right tools and techniques
Okay.
to sift through the noise and extract those meaningful insights.
All right. This has been a wild ride so far.
Uh-huh.
We've gone from robot stock pickers
Emma?
to market mapping
Mm-hmm.
to time travel. Well, not actual time travel, but predicting the future of the market feels pretty close.
It does.
Before we move on to the specifics of these predictions,
Yeah.
is there anything else that stands out to you from these papers? Anything you want to highlight?
You know what really strikes me is how these models aren't just spitting out numbers.
Yeah.
They're actually providing valuable insights into what's driving market movements.
Okay.
For example, they were able to identify which specific economic indicators were most informative for predicting returns.
So they're learning to think like a seasoned investor.
Yeah, exactly.
Now that's what I'm talking about. They're not just number crunchers. They're actually learning to understand the forces that shape the market.
Yeah, I think you're onto something there.
Okay.
These AI models are showing us that there's a lot more to market prediction than we might have thought.
Okay.
They're uncovering these hidden patterns, revealing the complex interplay of factors that that drive returns, and ultimately giving us a glimpse into the future of finance.
Okay, that's officially blown my mind.
Uh-huh.
But let's not get too ahead of ourselves
Right.
before we start planning our early retirement based on AI-powered stock picks. Let's dig deeper into those specific predictions and see what these models are actually telling us about the future of the market.
Yeah, let's do it.
All right, I'm ready to get into the nitty-gritty here.
Okay.
These researchers built these complex models.
Yeah.
They tested them against the market, but what do they actually see? What kind of predictions are we talking about?
Well, one of the most impressive findings was that the AI models were actually able to anticipate recessions
Really?
and reduce market exposure beforehand.
Wait, hold on. They could see a recession coming before it actually hit.
Yeah.
That's incredible. It's like having a financial early warning system.
Exactly. It's like the model is learning to recognize those subtle signals and patterns that come before a downturn in the economy.
Okay.
And what's remarkable is that it's not just identifying these signals.
Yeah.
It's actually able to adjust its portfolio
Okay.
to reduce risk and potentially protect investors from significant losses.
So it's not just about making money.
Right.
It's also about not losing money.
Exactly.
That's a crucial distinction. Imagine if we could have seen like the 2008 crisis coming.
Yeah.
That would have been that would have been huge.
Absolutely. That's the power of these these advanced techniques. They're not just about generating returns. They're about providing insights that can help us make more informed and more strategic decisions.
Okay, so they can predict recessions.
Uh-huh.
What else can these models do? What other secrets have they unlocked?
Well, they were also able to identify which specific economic indicators were most informative for predicting market returns.
Okay.
So think of things like interest rates,
Yeah.
inflation, unemployment numbers,
Right.
all those data points that economists and investors kind of obsess over.
The classic economic tea leaves.
Yeah, uh-huh.
So the AI is basically telling us which tea leaves to pay attention to.
You could say...
Yeah. But it's more than just identifying those important indicators.
Right.
It's about understanding how all these factors kind of play together.
Okay.
And how they influence those market movements. It's like the model is learning to read the economic story.
Okay.
Piecing together the narrative from all these all these different data points.
So it's not just number crunching.
Yeah.
It's actually like learning to understand the economy.
Exactly.
That's pretty impressive.
Yeah.
But let's get back to the market predictions themselves.
Okay.
Did the researchers actually share any specifics about what their models are forecasting for the future? Like, should I be buying or selling right now?
Well, I'm afraid I can't give you any specific investment advice.
Oh, come on.
But I can say that the research suggests that these AI models have the potential to give valuable insights into future market trends.
Okay.
Remember, they were able to achieve those impressive Sharpe ratios.
Uh-huh. By accurately predicting market movements that weren't part of their training data.
Okay, so no hot stock tips.
No.
But you're saying the research is saying that these models are the real deal.
Yeah.
They can actually see things that we humans can't. That's it's exciting and a little bit scary, to be honest.
I understand the apprehension. It's natural to feel uneasy when machines start to kind of encroach on what we traditionally think of as human domain, like financial forecasting.
Right.
But I think it's important to remember that these AI models aren't here to replace human judgment.
Okay.
They're here to enhance it.
I like that. Enhance, not replace.
Right.
So it's more like having a superpowered research assistant by your side.
Exactly. Think of it as a collaboration.
Okay.
Humans are still setting the goals, interpreting the results,
Right.
and making those final investment decisions.
Okay.
The AI is just giving us a much clearer view of the landscape.
Okay, so it's not about surrendering to the robots.
Right.
It's about learning to work with them,
Yeah.
to use their strength to our advantage.
Yeah, I think that's a great way to put it.
Okay, I can get on board with that.
Okay.
But I still have to ask, what about the risks? What could go wrong with all this this AI-powered investing?
That's a crucial question, and I'm glad you brought it up.
Yeah.
It's important to approach AI with a healthy dose of skepticism and critical thinking.
Okay.
One of the biggest risks is over-reliance on the technology.
Okay.
It's easy to get caught up in the hype and start blindly following the recommendations without really understanding the logic.
Right. We can't just let the machines do all the thinking for us.
Exactly. You always want to be questioning those assumptions, double checking the data,
Right.
and making sure that you understand the limitations of the technology. Remember, even the most sophisticated AI model is only as good as the data it's trained on,
Right.
and the algorithms it uses.
Garbage in, garbage out, as they say.
Exact. And another important consideration is those potential black swan events.
Okay.
The unforeseen, unpredictable occurrences
Right.
that can throw even the best laid plans off course.
Yeah.
AI models are trained on historical data.
Okay.
So they might not be equipped to handle these truly unprecedented situations.
That makes sense. Like, how could an AI have predicted the pandemic or the war in Ukraine?
Right.
Those were events that completely reshaped the global economy.
They did.
And no amount of historical data could have fully prepared us for them.
Precisely. So while AI can provide those valuable insights and enhance our decision making, it's crucial to remember that it's not a crystal ball.
Right.
We still need human judgment, intuition, adaptability,
right,
to navigate those complexities of the financial world.
Okay, so AI is a powerful tool.
Yeah.
But not a magic bullet.
Exactly.
Got it. Now, I know we've been focusing on the big picture here, but I'm curious about the practical applications.
Okay.
How can someone actually use these AI insights to improve their own investment strategy?
That's a great question, and it's something we should definitely explore further.
Well, let's do it. After all, what good is all this knowledge if we can't actually put it to use?
Right.
Okay, so we've covered a lot of ground.
We have.
We've talked about complex models, shrinkage, random Fourier features. My head is spinning a little bit, but in a good way. Now, the million-dollar question, how can all this AI wizardry actually help someone invest smarter?
Well, the first step is kind of shifting your mindset. Don't think of AI as this, scary, complex thing that's only for Wall Street geniuses.
Right.
There are tools and platforms out there that are designed for everyday investors.
Okay.
Making these insights accessible to anyone.
So ditch the fear factor. But what about those of us who aren't exactly tech wizards? Do I need to learn to code to benefit from AI?
Not at all. You don't need to be building algorithms from scratch.
Okay, got it.
There are already services out there, sometimes called robo-advisors, that kind of do the heavy lifting. They use these sophisticated AI models that we've been talking about to analyze tons of data and recommend investments tailored to your goals and risk tolerance.
So it's like having a personal AI investing coach.
Yeah, kind of.
In my pocket, sign me up. But wouldn't that mean blindly trusting a robot with my money?
That's where the human element comes in. Right. Technology is a tool,
right?
But you are still the captain of your financial ship.
Okay, I like that.
It's crucial to understand what's driving those recommendations.
Okay,
not just taking them at face value.
So it's a partnership.
Yeah.
AI providing the insights, but me making the final call.
Exactly.
Okay, that makes me feel a lot better.
Good.
But what kind of signals are these AI models picking up on? What should I, as an investor, be paying attention to?
It's more than just the usual economic indicators.
Okay.
These models can analyze things like news sentiment.
Okay.
Are people feeling optimistic or doom and gloom about the market? They can even process information from social media, getting a sense of the collective mood.
Wait, so my Twitter feed is actually valuable market research now.
It highlights just how much data is out there,
right,
and how AI can sift through it all in ways that we just can't.
Okay.
But remember, it's not about replacing your own analysis.
Yeah.
It's about adding that extra layer of insight.
Got it. So AI is like my superpowered research assistant, not not my financial overlord.
Exactly.
But if these models need tons of data to work, isn't that a disadvantage for like the average investor?
Right.
I don't exactly have a Bloomberg terminal at home.
That's the beauty of these AI-powered platforms.
Okay.
They already have access to vast amounts of data.
Yeah.
By using them, you're essentially leveraging the power of big data without having to, to build your own data empire.
That's pretty awesome.
Yeah.
It levels the playing field, giving everyone access to the same kind of sophisticated tools that were previously reserved for Wall Street.
I think so.
But let's be real for a second. No investment strategy is foolproof, right? What are some of the risks or downsides to keep in mind?
One risk is becoming overly reliant on the technology, forgetting that AI is a tool, not a fortune teller.
Right.
You can't just blindly follow recommendations without understanding the logic behind them. Yeah.
It's like using a GPS without knowing how to read a map.
Yeah.
You're kind of at the mercy of the technology if something goes wrong.
Right. No matter how fancy the algorithm, it's still based on data and assumptions.
It is.
Blind trust is never a good strategy.
No.
What else should we be cautious about?
Well, remember those black swan events we talked about?
Yeah.
The unpredictable stuff.
Right.
AI models learn from the past, but they can't foresee the truly unprecedented.
Okay.
No amount of data could have predicted a global pandemic or a sudden war.
So AI can help us navigate the known.
Yeah.
But we still need our own judgment for the unknown.
Exactly.
That makes a lot of sense.
It's about balancing the power of AI with those irreplaceable human qualities of intuition, adaptability, and a healthy dose of skepticism.
Okay, so to sum it all up.
Yeah.
AI is a powerful tool for investors, but it's not a magic solution.
Use it wisely, understand its limitations, and never stop learning and adapting.
Couldn't have said it better myself.
Okay.
Now, here's something to ponder as you kind of go forth on your investing journey.
Good.
If AI can learn from past data to predict market trends, what other complex problems could it help us solve in the world of finance and beyond?
Right.
The possibilities are truly endless.
That's a great question to leave us with.
Yeah.
And who knows, maybe we'll dive into some of those possibilities in a future deep dive.
Maybe we will.
Thanks for joining us on this deep dive into the fascinating world of AI and investing.